Welcome to Financials 101, a four-part video series designed to give you a foundational understanding of the three main financial reports every small business owner should understand and use. This video covers the cash flow statement. I'll explain how this report is structured, where the numbers come from, and why this report is useful. Let's get started. I'll begin with this simple statement. Every financial activity of a business creates an asset or a liability. This statement is the basis of all three financial reports. In this video, we'll focus on tracking financial activity using the cash flow statement. It shows where the money goes over a future period of time. It's a forward-looking document. And as such, you need to use your best thinking to project future revenues and expenses. Understand that no one gets it 100% right, but you do want to get close in your estimations. A cash flow statement shows all the money coming in and all the money going out of your business. And as I mentioned, it's a forward-looking document. Now you can look forward to next month, next quarter, or next year. It depends on how far forward you want to look and how accurate your predictions may be. In any case, because these are essentially made-up numbers, they're estimates based on your best thinking, you need to document that thinking, and that means you need to write down how you arrived at that particular number. You're assuming certain things will happen. What are those assumptions? You need to write those down. Anyone reading a cash flow statement won't necessarily understand your thinking. So by writing down your assumptions, documenting your assumptions, you'll give them an idea of how you arrived at a particular number. And perhaps more importantly, 6 months or a year from now, you yourself won't remember what you were thinking. So it's useful for you to understand or remind you what you were thinking at that time. As I mentioned, a cash flow statement is all the money coming into the business and all the money going out in a foreseeable future. By all the money coming in, it really means all the money coming in, not only revenues from sales, but any loan money you might have coming in, any investments from you or other people, interest earned, sales tax collected even though that's not your money, it comes into your business for a period of time. Any money coming in is shown, all the money coming in. And by all the money going out, I mean just that. Not only your operational expenses, your overhead, but any loan payments you made, any investments the business may make, anything in your saving, moving out of checking into savings, owner draw, interest paid, sales tax paid, any other taxes paid, any other money going out. It captures everything going out. If we look at all the money coming in minus all the money going out, we're going to get a net change in cash. And this can be a positive or negative number. It simply indicates the natural ebb and flow of money through your business. However, we look at the beginning of a period, and most cash flows look on a month-by-month basis. So let's say we look at the cash you actually had in your banking account at the beginning of that month. Then we apply the change that happened from operating your business during that month, and we get some change, some cash at the end of that month. That is the cash your business actually has in the bank at the end of the month. Now, it's important to realize that a negative number in that cash at the end of the period, if that is negative at all, that is a major warning sign. That is giving you a heads up on something has to change. You cannot have a negative. There's no such thing as a negative bank balance. The bank may say there is from an accounting perspective, but actually having actual cash in your account, there is no such thing as a negative. I mean, it's zero or a plus, but it's not negative. So if you see a negative number at that cash at the end of period, you need to do something prior to that month, let's say, in order to make that number zero at the very least, but hopefully positive. The first place you would look as a business owner, of course, is selling more product in the time period before that negative so that you increase sales and thereby making this negative number go away. At worst case, you may have to kick in some of your own cash to make sure that negative number won't happen. Now, before we look at an actual cash flow statement, I need to make a distinction between the profit and loss statement and a cash flow statement. There's some significant differences. If there weren't, you wouldn't need a second statement, a cash flow statement, for instance. If you recall from our video on the profit and loss, this is a typical structure of a profit and loss statement. And the taxes there near the end there, that includes your B&O tax and self-employment tax if you're a sole proprietorship. If I draw now a structure of a cash flow statement, it too has a top line, gross sales, and like the profit and loss, it does not include sales tax, at least at this point. However, the next line item out is cash out for goods. This is cash that you spend for things that you will eventually sell. This could be raw materials, but it could also be a finished product bought wholesale from a distributor. It's the cash out for stuff you will eventually sell. Please understand, this is not the same as cost of goods sold. So in a profit and loss statement, if we have a certain amount of sales in a month, we look at the cost to make those sales happen. In a profit and loss statement, we look at the money we spent buying that in whatever month we bought that stuff in, the raw materials. So I'll give you an example. So let's say we sell 30 widgets in a given month. In a profit and loss statement, we look at the cost, the wholesale cost, or the production cost of those widgets, just those 30 widgets. But in a profit and loss statement, let's say in that same month, beginning of that month, we actually bought 100 of these widgets. We only sold 30 that month, but we actually bought 100 widgets that month. That's when we wrote the check for, 100 widgets. That's the number that appears in the cash flow statement, the actual amount of money that went out for those goods that you will eventually sell. The profit and loss statement covers only the cost of those goods sold, cost of goods sold that particular month or in that particular period. A very important distinction. We then look at the operating costs. That's the cash out to operate your business, the fixed costs. Those are pretty much the same as the profit and loss statement. Then we look at a general bucket, if you will, of catching any other cash that may be coming into the business other than revenue, other than cash coming in from making sales. This could include the sales tax collected on behalf of the state. It could include any investments that you as the owner or other investors made into the business in a particular month. If the business loaned money and that person you loaned the money to is now paying back, that's a loan proceed, that would be included. The idea here in this other cash in bucket is to capture any other money coming into the business, no matter what it is, that didn't come just from selling your product or services. Then we have a generic bucket that captures any other money going out other than the cash out for operating your business. Any other cash out could include the sales tax paid in the month that you pay it, any interest paid, any taxes paid, the owner draw that you might have taken, your loan payments. Remember, the profit and loss statement didn't cover loan payments, doesn't show that. A cash flow statement does show it. Also, any equipment you might have purchased through the year, that shows here. Any other cash going out is shown there. And for taxes, that's where we bring certain numbers over from the profit and loss there too. Those are the same. Now, if we look at all the money coming into the business and all the money going out of your business, we're going to get some sort of net change in cash. And again, that can be a positive or negative number. Not to worry unless it's a negative number for several months in a row. That could be a problem. But normally it just shows the natural ebb and flow of cash coming in and out of your business. We apply that change, plus or minus, to the beginning cash of that period, say the cash you had in the bank at the beginning of the month, and then we come up with cash at the end of that month. So there you see the structure of the typical cash flow statement that we use. Other cash flow statements may have different categories, but basically they all show all the money coming into the account and all the money going out of an account. Let's take a look at what this might look like in a spreadsheet form. I'm using Excel here. Of course, you can use any spreadsheet software you want, and you can even do it by pen and pencil. However, this is how we lay it out. You can see across the top there that we have each column represents a month. I've labeled them month 1, month 2, month 3, etc. You can put in the actual names of the months if you want. And then on the left side, we have two big boxes, I'll say. One is cash in and one is cash out. I'll start with the cash in. Cash in is two buckets that capture all the money coming into the account. The first bucket is revenue from sales. This is money that comes from you selling your product or services. And in this case, there are three revenue streams. So one may be, let's say you're a landscaper. One revenue stream might be design. Revenue stream 2 could be installation. Revenue stream 3 is maintenance. And you may want to track the income of each one of those streams in each month throughout the year, at least looking forward. In the shaded areas in this particular spreadsheet, those are calculations that happen. So you can see that on line 9 there, the total revenue from sales is the sum of the three revenue streams in any given month. The second bucket that we have cash in is other cash in, and that captures all the money coming into the business that doesn't come from selling products or services. This would include sales tax collected, any owner contributions that you might have kicked in, any money coming in from loans, an SBA loan or a loan from your Uncle Bob, something like that, and also any interest received on your savings accounts or checking accounts or any other investments the business might have made. Again, that subtotal is on line 16, other cash in, total there. And then we add the total coming in from sales and the total coming in from any other income stream, and we get total cash in. The next box is cash out, and as you've learned from other videos there, here the first thing that comes out is cash out for goods. This is cash out for products or raw materials that will eventually sell. And you record how much you spent on any, say, raw materials or in finished goods from a wholesale distributor in the month that it happens. Again, this is very different than cost of goods sold. This is the cost or the cash going out of the business buying for something that you'll eventually sell. I've also broken out packaging because that's a variable expense. Any variable expense would go in here and be part of this cash out for goods, if you want to think of it that way. But I've broken out packaging here in case you want to make that a separate line item. Again, the total cash out for goods or purchases is on line 23, and it's the shaded orange there. Then we go into operational expenses. The first section is general expenses. This includes rent, utilities, telephone, licenses and permits, office supplies, postage. It could be any number of different things, but these are the very common ones for business. And again, the total for those general expenses in any given month are added on the pink line there. Then we go into marketing expenses. This is any money you spend promoting your business. In this case, I've listed advertising and promotion, website design, and a monthly website fee. Again, when those fees are incurred or those expenses are incurred, those amounts are entered into the appropriate cell in the month. And a total for that is also found on line 41. Next layer down is payroll. That's payroll expenses. This would kick in if you have a corporation or an LLC. If you have a sole proprietorship, then anything that is profit to the business is considered your pay anyway, whether you call it payroll or not, but payroll taxes don't come out of that. Anyway, total payroll expenses is accounted for in this section. If we add up all those operational expenses, general expenses, marketing expenses, and payroll expenses, we get line 49, the total cash out for operations. The second general bucket capturing any money going out is anything related to expenses that don't concern the day-to-day operation of your business. So this would be the sales tax paid in the month that you pay it. any B&O tax, a loan payment that you make. Remember, the profit and loss statement did not include a loan payment. A cash flow statement does show that. Any owner withdrawal you make, retirement savings, any equipment you buy, furnishings, any other money going out of the business that is not related to operations. Then you get a total of all the money going out there on line 62, total cash paid out. If we then calculate all the money coming into the business minus all the money going out of the business in a given month, we get line 65, a net change in cash. Again, this can be a positive or negative number. It just shows the natural ebb and flow of money through your business. That gets applied to the beginning cash of that month and creates then the ending cash. When you apply that positive or negative number to that beginning cash, you get an ending cash. The ending cash of one month becomes automatically the beginning cash of the next month. Again, you would go through that same process. All the money coming in that next month, all the money going out the next month results in some net change in cash, positive or negative. That gets applied to the beginning cash for that month, resulting in an ending cash for that month, which automatically becomes the beginning cash for the following month. And so it rolls through the whole spreadsheet. Again, I want to emphasize that that bottom line there, ending cash, cannot be a negative number. That doesn't exist. Therefore, if you see a negative number appear in that line, you need to do something before that period, so before that month, let's say, in order to make sure that number is not negative. It can be zero, it's not good, but it can't be negative. Make it positive. The best way to do that is to increase sales in the prior months, perhaps decrease your operational costs is another way to do it. Last resort would be to kick in some of your own money as a owner investment to try to bring that bottom ending cash line to a positive number. So that's how a spreadsheet could be developed that will allow you to project forward either 12 months or 3 months or however far forward you think you can do, and how and why it is useful. I'll leave you with the words from Michael Dell, the founder of Dell Computer. He agrees also that cash flow should be reviewed regularly and that it is vitally important to every business. This video was made possible by funding from the Pacific County Economic Development Council. My name is Jim Williams. I'm a trainer and business coach with Enterprise for Equity. Our mission is to help people with limited income start and grow their own successful businesses. For more information about our classes, please contact us.